Your point around the UK market's quite interesting. There's a lot of head in the sand type behaviour going on over there, and people have just got to get a bit more realistic and clean up their problem.
There's always a balance between, sort of insolvency, which is, basically shaving the economy back and getting ready for new growth. And during the 90s, there was pretty harsh measures dealt out by banks, a lot of insolvencies, and perhaps some companies that shouldn't have been made insolvent went insolvent. But the growth in the UK anyway grew back very quickly, and so the boom of the next following 10 years, perhaps from 95 to 05, was perhaps because of that, partly because of the insolvency regime. Nothing's ever quite right, but it's interesting to draw the parallels between the various different recessions that we've had over the last 20 or 30 years.
Cathro and Partners presents The Cut, a podcast about all things insolvency.
Good evening, everyone. This is the next episode of The Cut. It's a series designed to interview insolvency and restructuring personalities, and today I have the pleasure of interviewing one of my colleagues in London, Simon Campbell, out of the Southampton office. How are you, Simon?
All good. Thanks, Simon.
How's and the weather's got to improve since I was there a few weeks ago, I hope?
It's got a little warmer. We can see summer in prospect.
Yeah, that's good. Yeah, look, just for background, the Cathro and Partners and the Quantuma have an alliance, and Quantuma is a global insolvency and restructuring firm. Simon's part of that, and really they are experiencing similar pickup in insolvency like we have here in Australia. So today we'll be covering off a bit about Quantuma and a bit of background on Simon and what we're seeing in the UK market and what we think the market may look like in the next 18 months. So, yeah, Simon, I might just hand it over to you if you just want to give us a bit of background on yourself and sort of how your career started out and sort of how you got to where you are now.
So yes, I'm a what's called a managing director. That doesn't mean I manage very much, but I'm essentially a partner. My title is managing director at Quantuma in Southampton, as you say. I'm mid-market, restructuring and insolvency, and I have been at Quantuma for 7 years or so. Before that, I worked at Grant Thornton and another mid-market firm called Phillips and Begbies Traynor. So I've been working in insolvency and restructuring for about 25 years or so. So I've seen a recession or two. And as you say, the tide is coming our way a bit in the last 6 months because of prevailing economic conditions. So it'll be interesting to see how that turns out.
Great. And I suppose if we just try and think of a couple of matters that you worked in over the last 20-odd years, I mean, is there one that sort of comes to mind that was of a really interesting experience and had some great I suppose situations or things that happen on the job?
I suppose one of my most interesting jobs is a job called Alpha, student accommodation. The business was constructing and renting out 19 or 20 blocks of student accommodation around the north. It was something of a Ponzi scheme, and a whole load of leaseholders had bought into units. They bought various units on the promise of 8 or 9% return per year, and they had not received their money, and indeed the whole thing was imploding. So I managed to wrest control of the blocks from the freeholder. There's a deal of legal complexity to it, but essentially managed to provide the leaseholders with a unit that they could get the income going forward. Didn't turn out to be 8 or 9%. Turned out to be more like 4 or 5%, but at least they had a control of their unit, and they were able to enjoy that going forward. So it was something of a success.
I suppose when you look at the insolvency laws that are in the UK, in a way, it's very similar to what we have in Australia, but there's a lot more. There's some sort of slight differences. Do you want to just run through, I suppose, the key insolvency options that exist in the UK market? So the audience understands what options are available in the UK market.
Okay, so you're talking about corporate rather than personal, are you?
Yeah, corporate.
Corporate.
Yeah, I think we'll just stick with the corporate ones.
Yeah.
Yeah.
So corporates, you have the two sides of liquidation with the dead-end terminal stuff, either via the courts, a compulsory liquidation, or voluntary liquidation, where you don't need to go to court and directors submit to a closing down process. So those are terminal procedures. The major restructuring tool is administration. I think you have that in Australia as well. And that's taken over from what used to be called administrative receivership, whereby you're able to pick up a viable business from an insolvent company and move it elsewhere and preserve the business and protect it. Administrative receivership used to be totally done on behalf of the secured creditor. Administration is an attempt to look after the interests of all stakeholders, including preferential and unsecured creditors. So that's the major restructuring tool. We then have company voluntary arrangements, CVA, which are agreements between a company and its creditors. We can't pay now, but we can pay later, like this. They're useful, innovative tools to keep the business within the same company with the same directors, and are very useful when a business has suffered a temporary setback, but something that can be sorted out over time. So that's Is that enough on CVAs?
Yeah, look, I mean, sure. I mean, if we look at a couple of those options, with the CVA one, that's sounds like it's very similar to what we call a deed of company arrangement here in Australia.
Yeah.
Is that a proposal that creditors get to vote on?
Indeed, yes.
And I imagine it's a compromisation of, and then you need the majority of creditors. That can be paid over a long period of time. Like some of the proposals we see on what we call the deed of company arrangement here in Australia is you can often have it paid over 12, 24 months if the creditors are comfortable with that kind of time frame. Is that the similar type of flexibility that the CVA has?
Well, we can go as much as 5 or 7 years. And it can be 10%, it can be 100%. It can await the sale of an asset. It can await, sort of simple income. It's a very flexible thing. The chief sort of issue for a director and shareholders is do they want to spend 3, 5, 7 years even repaying the sins of the past? Can they see an upturn? Do the cash flow forecast support future profitability and have the problems that have created the issues that they have they been solved adequately? So those are the crucial aspects. But it is a tempting financial, a tempting sensible arrangement, and it's a positive restructuring tool. The only issue most recently is that we have had a change in the priority of creditors, whereby revenue for VAT and PAYE have now become preferential again. That makes CVA slightly more difficult.
Right.
If you have a large revenue debt, because revenue have to be paid in full before unsecured creditors get anything. So that has changed the viability of CVAs and the calculation, if you see what I mean. and made them more difficult. And that has
Wow.
brought to the fore two restructuring tools that we may come on to that have been provided by the government over the COVID period, one of which is restructuring plans and the other is moratoriums. And that's brought those more into play, as it were.
Yeah, well, we'll get to that in a couple of minutes, but let's just stick with that that change in priorities. I mean, from a tax revenue perspective here, they rank equally with other unsecured creditors, and it wasn't really until we used to have what's called sales tax. I think it was 30 odd years ago when there was some sort of priority. So this is almost a return back to the future type situation now that UK is seeing with the tax taking a priority over other creditors, which that's very interesting. Very interesting. So
they now take a much more active interest in insolvencies because they have much more of a stake in them. I have to say, HMRC have struggled over the COVID period to actually react properly to these circumstances. But necessity, it's necessary for them to become more involved because they're a much larger stakeholder. And I'm not going to say it's a great thing from our point of view in terms of our ability to turn companies around, but it is what it is. So we have to deal with it.
And just with the employees, they still sit in. Do they sit in priority to other creditors? And,
yes.
and do they get the kind of government support here, like we have in Australia, where what we call the Fair Entitlements Scheme here is will cover entitlements outside superannuation in the event that a company goes into liquidation. There's insufficient funds to pay out those priority creditors. Do you have some similar scheme in the UK?
Yes. So employees are preferential in terms of their unpaid wages and holiday pay and pensions, any unpaid pension contributions. So they are what's called first preferential creditors. HMRC are second preferential creditors. But what you're referring to is what we call redundancy payments awards, whereby they are able to claim, the employees individually are able to claim for the amount that they are both unsecured and preferential claims from the government up to a certain weekly limit. And then the government is then able to claim in their shoes in the insolvency if there is a payout preferentially. Does that make sense?
One of the yes, it does, and it sounds very similar to what we have here in Australia. But what we've also seen here in Australia is the government take an active role in certain recoveries in companies that are in liquidation, where you've got powers to sue for claims like insolvent trading and preference claims. Do you see? Well, maybe the first question we should ask is, what are the kind of claims that a liquidator has in the UK that they can pursue parties like the directors for insolvent trading or similar claims like that? Is it wrongful liability, or is there what are the kinds of powers and claims?
Yes, there's a number of what we call antecedent transactions that we can pursue as liquidators and indeed as administrators. Slightly larger number of powers as liquidators, but they you'll be familiar with them. Wrongful trading is one. It's quite difficult to pin wrongful trading on directors. In fact, as it turns out, quite often we go under the term misfeasance rather than wrongful trading. But wrongful trading is, yes, essentially making money. Losing money when the directors, losing creditors' money when the directors should have known that the company had no prospect of survival. So others, preference, paying money to one creditor in preference to another when the company was clearly insolvent. There's some inequality there between creditors, and then transactions that undervalue. So selling assets off at undervalue, fairly straightforward.
Yeah.
And the normal sort of thing, misfeasance, sending money where it shouldn't go. So yeah, have you got any others that I've missed?
No, that covers off most of them. We have the breach of director duties, which I suspect is the misfee and stuff that you mentioned. But most of the claims that you raised were very similar here to in Australia as well. What we do find though is we have litigation funders, which I know the UK have a very active market in that space too, but we also have the government who pays out these employee entitlements, competing with the litigation funders for litigation funding agreements, where they come in and fund on much, much better terms than what litigation funders expect out of the actual action. So it's
the government take a stake.
Yeah. So the government funds generally where they'll fund us for the costs, and then they'll just ask for their costs back plus whatever surpluses goes towards the payment of the employees, which is they're already in priority for. That's a very simplistic view of it, but we've seen a very active government department there get in there and play a very big role in our market to recover monies. And I can understand where they're coming from, because if I take sort of an IT company that I had last year, and the crystallisation of those entitlements and the liquidation that followed triggered a $3 million payment that the government had to pay that would otherwise would not have had to pay. So in that sense, they would look at whether there's any claims and start looking at supporting liquidators in that situation to fund potential claims that would otherwise not get funded, because either there's insufficient funds in the job to be able to do it ourselves, or the alternative is you go to a litigation funder who has takes a percentage of the outcome. So they're sort of stepping in and doing something similar. But do you see sort of that? Does that exist in the UK, or is that you're sort of getting the funding through from litigation funders?
No, it doesn't. That sounds really interesting that the government would get involved in Australia. I hadn't heard that before. And I kind of wish that we had something similar, some sort of not morality police, but some sort of idea that the government stepped in and helped out. As you well know, it's sometimes a lonely place in terms of insolvency when you have no funds. You can see something's clearly wrong, and you want to do something about it. You can recover money for creditors if you had a bit of money, but it's a chicken and egg situation. So litigation funders, as you say, step in that case. They take around about the 50% mark of the winnings, if there is winnings, but they cover all the costs, and as such, it's a very sensible route to recovering money for creditors. But if there was another way, I'd like to see it. The problem with the government here is the official receiver, the insolvency service, who don't have an official receiver. That's the terminology we have over here. The official receiver is the appointee. They are chronically underfunded, as far as I can see. There are good people in there, but their remit is they have a hard enough time disqualifying directors when they should be disqualified. Far too many get off, in my view. The idea of them actually sort of taking on litigation and so on, I just don't think they have the funding for it or the personnel for it. As I say, that they are not very commercial minded. They will they will go after directors to disqualify them, but they are nowhere near having the ability to work with us, as it were. So it's not an option in the UK. Would that it were, perhaps?
Yeah, look, it's been an interesting. It's been something that's been going on here for several years, where it's the Attorney General's office here. So you've got sort of three government departments. You've got the regulator being the Australian Securities and Investment Commission, and then you've got the tax office, and then you've got the Attorney General's office that deals with the employee entitlements. And so they're all quite separate, but the Attorney General's office have taken the initiative to set up a litigation funding type arrangement, and it's worked out as far as I know, very financially successful for them because they're paying hundreds of millions of dollars every year in employee entitlements that get spat out as a result of the liquidations that happen here. They take some actions, and because they can bring a strong balance sheet, support around adverse cost, all those kind of things that we all fear that we don't want to have if we decide to self-fund these things. And it really brings parties to the table to settle, and there's lots of settlements that happen as a result of that sort of strength in funding that and just that tactical play that can happen as a result of the Attorney General coming, or as we call it FEG, coming to the table and backing the liquidator. I think the UK government should talk to the Australian government because it's not it can be set up. It's something that just has to understand the way the machinery of government works in the respective countries, and it does generate a recovery that ultimately reduces what the annual cost is to the government to fund these entitlements.
Yeah. Yep. No, sounds interesting, but not. Yeah, that's left field for me.
Well, I'll help you out on the side there, Simon. You let me have a chat to the regulator, and I'll have a chat to him for you.
We have the serious fraud office and so on, various for really egregious cases. But in a way, they tend to get in the way of recoveries for insolvency and for creditors. It gets wrapped up in legal process for years, and that's I see that more as a block for the recovery of funds for creditors than a help. Is
it more criminal or is it still civil?
Yeah, criminal sort of stuff. Yeah. So if you get the FFO wading in, you're in trouble really.
I mean, our regulator, which is the ASIC as we call it, is that undertakes the criminal elements of the insolvency. It's not really up to the liquidators to do that. They report that back to ASIC and give them the support that they want. Okay, so maybe we can just move on to sort of the next part of the podcast, and that is around the current market. What are you seeing at the moment in the UK market? Is there any particular trends in terms of insolvency and restructuring?
No, we've had a reasonably thin time as insolvency practitioners over the last 3 years due to government funding being put in. I suspect you're much the same, and there's also been a relatively forgiving atmosphere amongst creditors of excessive debt. So that is beginning to unwind. We have the obvious problems of the hospitality industry and the travel industry being really under the pump. But other than that, I don't think there's any real strands that I could point to, industries or that are really struggling. There has been a general pickup in the last this year of inquiries. The issues that we have are quite often people talk to us and then go away, and don't actually do anything about it because there isn't the pressure on them to sort the issues out. I got a job last year, which was a £5 million business that's emptied cash facilities, so parking meters and train stations and so on. It collected cash and put it in the bank and so on. Now you can imagine that over COVID, as the business has gone down and down. And I think it turned over about 1.5 by the time I got to it. But the point I'm making about it is that by the time I got to it, and the guy said, "Yeah, I probably can't trade anymore," there were absolutely no assets within it whatsoever. We charged £5,000 for an initial, put the company into liquidation, and there were, I think we scraped together about £2,000 in terms of worth of assets. The point about that is that companies have been allowed to trade to death much more than they ever were. When I started in the early 90s, banks were knocking over companies, for various breaches pretty quickly, and banks held sway. and revenue was similarly strong. I think what we're seeing now is, as well as a forgiving atmosphere, is just banks being slightly politically neutered, as it were, by perhaps the sins of the past from 15 years ago. HMRC being quite underfunded and quite a sort of their morale is not great, should we say. And in general, people aren't pressing to recover debts as much as they used to. Is that what you're seeing in Australia?
Not really, actually. We've started to see a bit what I would call the more normalisation pre-COVID type behaviour, where and I would say it's only kicked in the last sort of 2 months, and we're recording this interview in April, so for the viewers, so when we do publish it, the timing, but we've seen definitely a return of what we call winding up applications to put companies into the compulsory liquidation, as you call them. The number of appointments that we're seeing here in Australia is hitting numbers that I haven't seen for a long, long time. I think one day in the last month I saw 70 odd liquidations, which is a lot for in one day, and then 15 odd voluntary administration. So we're starting to see a pick up in that sense, which I sort of think it's a catch up on the low numbers during COVID. Look, the example you gave, Simon, around that £5,000 example is there's a number of those kind of examples in our market as well, where you're seeing the directors almost just keep going till they run out of money.
Yep.
Not because they've been insolvent for 3 or 4 months, they've been insolvent for 3 or 4 years.
Yep.
And so because of the lax and the soft enforcement positions that were taken both by the banks and the government and the landlords over here, now that's all somewhat returning and being normalised. Yeah, look, I mean, I think, we're sort of a bit behind in the interest rate rises. I think in the UK the interest rate rises have been a lot more earlier and brutal. We've gone. I think we've had 10 interest rate rises in the last 11 months or something, which again you could say is fairly aggressive. So we're probably still suggesting that there's going to be a fallout around that, combined with cost of living and we've still got very low unemployment. So we're not seeing any signs where there's been massive redundancies, like I've certainly been in the US and potentially in the UK as well. But we'll start to see some of that, I imagine. But your point around the UK market's quite interesting. It just sounds like there's a lot of head in the sand type behaviour going on over there, and people have just got to get a bit more realistic and clean up their problems. Is that sort of the feeling that you have?
Well, as an insolvency practitioner, of course, I would have that opinion. I think there's always a balance between sort of insolvency, which is basically shaving the economy back and getting ready for new growth, and the natural wastage of balance sheet value that an insolvency necessitates. So, during the 90s, there was pretty harsh measures dealt out by banks, a lot of insolvencies, and perhaps some companies that shouldn't have been made insolvent went insolvent. But the growth in the UK anyway grew back very quickly, and so the boom of the next following 10 years, perhaps from 95 to 05, was perhaps because of that, partly because of the insolvency regime. Whereas in 2008, we were all expecting a lot of insolvency, and there was some, particularly from the top down, because of the well-documented banking crisis. But there wasn't so much as one would expect, and therefore, perhaps there were a lot of the zombie company problem. Lots of things survived that perhaps shouldn't have, and the answer is somewhere in between, isn't it? A lot of businesses were saved, a lot of jobs were saved. a lot of pain, and balance sheet loss was saved. But at the same time, you got sort of anemic growth and certain problems. Nothing's ever quite right, but it's interesting to draw the parallels between the various different recessions that we've had over the last 20 or 30 years.
Yeah. You mentioned earlier in the podcast about other insolvency options like the restructuring plan, if I got that terminology right. Do you want to just sort of swing back into that space and run through those?
Okay. Yes, I have to say I haven't done a restructuring plan, so I'm talking. I'll talk through what I've read about them rather than actually having done one. They're complex restructuring procedures via the court, and so there were a number of modifications brought in by the government in, I think, June 2020 in response to COVID and the problems that came from there. One of them was relatively straightforward. It was called a moratorium. You may be familiar with the term. I don't know whether you have the term over in Australia. I don't know whether I'm actually used Latin in Australia, but it just means hold off, basically. And
that's right.
This is a useful tool whereby an insolvency practitioner just is able to ring fence a company for 1 month, then 2, and then with the consent of creditors or the court, perhaps 12 months, whereby they can see that if allowed, the company will pay all its debts back. It really helps, from the point of view of something like COVID or, I don't know, a fire at a factory or something like that, when you can see that it just needs a breathing space, then it is quite a sensible and useful tool. It hasn't been overused yet and perhaps needs a few tweaks, but it is a sensible, if applied properly, a sensible tool for just holding things off, and it's not too expensive. An insolvency practitioner oversees it, and that's all. Quite a useful tool. So we then have restructuring plans, which are much more complicated, require court approval, and they are a complex version of a CVA, whereby each pot of creditors, each section of creditors, and a section might be HMRC, for instance, a bunch of leaseholders, asset providers, you section off various parts of the creditor body, and you provide them with a specific outcome, a specific write-down, and you provide that in a court document proposal to the court, whereby each creditor has a certain write-down and method of sorting, explaining it very well, but you then go to the court, and the court needs to see that the creditors, each pot of creditors, are treated, or the outcome for them is better than would have happened in another, perhaps administration, another sort of procedure. So the problem with them is they require a lot of legal and insolvency practitioner inputs. Costs can be anywhere between 100 and 300 K's worth of professional costs, and they're not really tailored for the SME space. They're much more large corporate sort of thing. But it has been done in the SME space, and hopefully, if the regulations around them and the legal precedent are established, then the costs may come down. They're an interesting tool. I've yet to use one, hence I've slightly stumbled over the explanation. But they may well overtake CVAs as the a restructuring tool of choice.
One thing that doesn't exist here in Australia is these pre-pack.
Right.
And I think that's quite popular in in the UK. Did you want to run through that? That's sort of where I think you get appointed as administrators, and there's a deal done almost the next day to ensure that there's not an excess. That the business continues. But is that? Do you want to just run through what these pre-packs are?
So a pre-pack is it's a sale a prepackaged sale via administration, what it sets out to do is to ensure that that a business is passed from one company to another as efficiently as possible. So it's not just the next day, it's within 5 minutes of appointment, the administrator signs a deal that is prepackaged to the current directors or a third party, or a combination of the two. And the reason that it is disliked amongst creditors is that quite often they aren't consulted and they're unaware, and suddenly they're presented with the same business in a different company, and they haven't had no ability to question that.
Yeah.
So it comes from a position where the directors consult, a decision is made to market the company, the business discreetly, and an arrangement is made to all the sales put in place as I'm sure you do, post appointment in Australia, all it's all put together, and then the appointment is made. And what it does, it means that the administrator, the insolvency practitioner, is never in control of the company, and therefore doesn't have the costs of looking after or trading the business and the potential risks and liabilities of that. So it's an efficient way of doing it, but it has its critics.
I mean, one of we don't have it here in Australia. We've had a lot of conversations and discussions around the fact that it does exist in the UK, and a lot of the issues you're just highlighting have been some of the reasons against the idea, in the sense that the creditors don't have as much say, and it sort of gets forced upon them more. And when it's really the way we view insolvency over here, and I'm sure it's the same over there, is that because the company's insolvent, the obligation on the office holders are to the creditors, not really to the shareholders, because the equity's already gone. So in that sense, to have something forced on the stakeholders that you're fundamentally having to make sure you're doing you're doing the proper duties towards, are actually not having as much say as what they'd hoped for. But we haven't seen, nor do we have that opportunity here in Australia to do these pre-packs, but it's been something that gets discussed simply because it does exist in the UK, and like any other jurisdictions where they've got different options and methods in doing things, you're always looking at how they compare and how they sort of are seen, and are they successful. So I suppose just to finish up, it'd be what do you see the market in the UK like over the next 12 to 18 months when it comes to sort of insolvency?
I'm perhaps not the best person to ask, given that I've predicted that there's going to be an uptick in insolvency for the last 3 years. And I've been wrong each time.
Oh, don't worry, you're not the only one there. Everyone else has been. So, but I think we're getting more right at the moment. So I think,
as ever, I'm right, but I've just I'm right at the wrong time. I cannot see a number of companies avoiding insolvency for much longer. I think the rise in interest rates is an important point that you made earlier. Interest rates have in many cases doubled realistically, and we haven't really touched on the landlord-tenant sort of relationship, but that is a fundamental change in a number of ways, in both over the last few years in terms of the power between a landlord and tenant, but also anyone who's got property in their portfolio, anyone who's lending into property has had to fundamentally change their models and their asset, their KPIs over the last 6 to 12 months, and that feeds through into a change in attitude towards various lends, and I think that's going to play out over the next 12 to 18 months, and I suspect that there's going to be a bunch of companies that are going to need to restructure, find different types of lending and so on, and perhaps avoid insolvency. But there will be insolvencies off the back of it, because there will be no way out for some companies. That is, it's got to be a reality. I'll probably do this podcast in 12 months' time and have to, eat my words, but there's got to be more trouble coming, in my view.
Yeah, and look, we've been very similar, like you have, in terms of getting the predictions wrong in the last 3 years. The market has just been very different to what it has historically. So it's been very hard for anyone, whether it's an insolvency practitioner, economist, or anyone trying to predict where things are going. But we definitely are, without doubt, seeing a pickup in insolvency appointments in recent months, sort of from about February 2023 onwards. And we're expecting that to continue for some time, because we're seeing that catch up. That there's a bottom line of minimum number of entities that need to go into liquidation every year, simply because the people running those businesses are not capable of running it. And during COVID, that was significantly below that minimum number that we would, that number that, it gets a bit artificial. And so that catch up of those entities, and we've got a lot of commentary in the market here around zombie companies, and it sounds like it's very similar over there.
Rewinding the clock back sort of 10 or 12 years, there's a cliff edge coming for a number of people. It's been pushed back and pushed back. But I think it's part of a healthy economy that some things have to go bust. It's unpleasant, but it's a necessity of life. And our job as insolvency practitioners is to do it as efficiently and as sensitively and as legally, if I can put it like that, as possible. And I think we also have a job to do in terms of when we come back to the issue of pre-packs and secrecy and openness and so on. We've got a job to explain ourselves to the business community as well, which is something perhaps we haven't been brilliant at over the last 30 years.
Well, hopefully this podcast will help that business community, Simon. So thank you very much for joining us, and that was really insightful. And certainly those that watch this podcast will get a better understanding of the UK market. We've done Singapore and the US in previous episodes. So thanks again for joining us. And Simon, Simon's from Quantuma in Southampton. And as we said earlier in the piece, Cathro and Partners is part of the alliance with Quantuma, and they're a great firm. Lots of experience, got a lot of presence around the world, 400 odd staff. A good bunch of people. I got to meet them in London 6 odd weeks ago, and really good people, and certainly got the right expertise to help in terms of dealing with companies that need some restructuring or insolvency services in the UK market. But thank you, Simon, and thanks for joining us via the video, and hopefully it all comes out brilliantly, and we'll speak to you soon.
Thanks, Simon.
Thanks for tuning in to Cathro and Partners The Cut. We hope you've enjoyed today's episode. For more insights, please visit cathropartners.com.au or feel free to like our LinkedIn and other social pages.